it's actually just an interesting discussion point on that too. I mean, if you look, you have to have unique bets to maximize that opportunity for rebalancing. Just digging into that a little bit more deeply, as I think folks are appreciating that as they're listening, is the rebalancing premium. If you own, 10 securities with zero dispersion, they're all doing the same thing. There is no rebalancing premium.
500 stocks in the S&P.
Yeah, and very few bets when we've done
is 1.2 bet as we've
And so this is a very important point. So it comes back to that universe concept we talked about at the beginning. A thoughtful universe makes a big difference. And then parsing that universe, right? What are things that are just acting the same and similar and aren't providing diversity? And how are you going through that universe in order to inject the most diversity to the portfolio with each additional bet, if you will, or in some cases, it's an asset class. But this is why really thinking about the universe is important, and then thinking about how it's going to be weighted and allocated to so that it reflects an appropriate amount of risk for the portfolio are essential to creating this optimal beta exposure. Right. And I don't know if now's the time that we move a little bit more.
I think we are. Can I just
hold on.
set the table?
Hold on. Before we move on, I just want to make, I also want to cover, because let's sort of, I think some people might sort of be wondering, well, this is all interesting in theory, but how should I map this to different products? And I think that there are obviously different products that are available to most investors that try to express sort of a risk parity concept, right? Some of these structures have limitations that require compromises, right? So for example, there's a risk parity ETF that's had really high adoption, and we're admirers of the concept and of the implementation. But, as an example of one of the compromises, because there was a desire to limit the amount of leverage in the portfolio while preserving the volatility and expected return, there was a decision to increase the duration of the bond component, right? So the bonds that are held in the portfolio are mostly kind of 30-year treasury bonds, right? And they don't really allocate to foreign bond markets. They rely pretty well exclusively on US rates. Well, obviously, over the last 30 years, having that duration bet has worked out really nicely, but in the recent environment, the weakness is exposed, right? Because obviously duration in this environment, you would have been much better off to hold a diversified ladder of different bond maturities and inside a portfolio that also holds commodities, et cetera, at higher, a little bit higher leverage than you would be to hold just high duration fixed income securities. There's also a limitation on the ability to invest directly in commodities in an ETF, right? And so instead, they've tried to proxy that exposure using commodity-related equities, right? So, that obviously has influenced their performance and would be expected to influence the performance of a product like that in environments where the actual commodities themselves are doing very well, but maybe the underlying equities are doing better than the market because of their commodity exposure, but because of their overall beta exposure, they're still being dragged lower, right?
You make a great point, because also think about those providers who have, sort of a full opportunity to use all of the various products, but they have limited their commodity exposures because they've looked through history and said, oh, the commodity stuff only happens sort of 15 to 20% of the time, and there isn't a risk premium there that we can explain. So thus we have decided to have a smaller commodity exposure in our risk parity products, which, again, has implications. And as an allocator or a buyer of product, you need to think those things through. Is that what you're looking for in your portfolio? Is that your desire? Certainly that has given those portfolios with less commodity exposure prior to the last 8 months, call it, pretty significant tailwinds. But now we see that changing a little bit. And so these are challenging things. There's no easy answers to these questions. And We, I think, would sort of side a little bit more on balance, and probably we can because we're smaller managers, at $500 million in AUM. We have more things that we might be able to do. You get to 10 billion or 100 billion, you get less. There are things that
for sure.
hamstring you a little bit.
This goes back to one company's perception of what beta is, right? There's also implementation that says, look, we've identified that in fact the risk premium is not the same between all asset classes. In fact, it's higher for equity, so we're going to overweight equity. So again, I think when you look at large institutions that are bought into the risk parity concept, they're not choosing one thoughtful risk parity manager and doing it all. They are allocating across the board because that's their best bet of getting that 4x4 truck that you spoke about, Mike, right? So I think it is, again, important to know that broadly speaking, we're speaking the same language, but there's implementation differences, and ensembles are always a great thing.